Hi, thanks for tuning in. I thought this time we'd have a quick look at some inside bars, and in particular, why there's relative safety found inside the range of a previous bar. You'll probably notice I'll often comment on an inside bar and say price has traded in the relative safety that is often found inside the range of the previous bar as an inside bar, saying that the bar itself is an inside bar and it's traded inside the range of the previous bar. This is the range of the previous bar. You can see that this bar, which is the inside bar, has traded inside that range, within it. When price trades inside the previous bar's spread or range, it is called an inside bar. The relative safety is safety against supply or further supply coming in. Now, whenever we talk about inside bars, we're talking about at least a two-bar combination or a combination of two bars combined. It can be more, but at least two bars. The first bar in a multi-bar combination is considered to be the initial or controlling bar, and the subsequent bar or bars that trade within its range are the inside bar or bars. In broad terms, so ignoring where price is in relation to the anticipated levels of support and resistance, there is relative safety against supply found inside the initial or controlling bar's range because the market has traded through that price range very recently, and because of this, spread and volume being activity in this case, will usually be reduced on the inside bar. The reduced activity is because most buyers or sellers who had an intention to trade within the range of the initial or controlling bar have most likely already done so and completed their transactions. So there is effectively less activity in this range, at least temporarily. This leaves the market activity lower than average on an inside bar, or at least lower than has been experienced more recently, because price is retracing back through a recently traded price range or zone. Effectively, a minor temporary supply vacuum develops within the range of the initial or controlling bar, and that is what causes this zone of reduced activity. Spread has a close relationship with volume. You can see that on this chart, which is why we look for spread volume anomalies. Spread is a reflection of volatility to a large degree, and volume is a reflection of activity. Now, volume also reflects force or effort, but under these circumstances, we're really looking at it more as activity. In general terms, the higher the volume, the wider the spread, and vice versa. So in general terms, the higher the volume, the higher the activity, and the higher the activity, the more chance there is of higher volatility, and therefore the wider the spread, and vice versa. So if activity is very low or volume is very low, there's low volatility most likely in the market, and because of that, the spread will generally be more narrow and even less than average. And that's why we look for anomalies, because when there's an anomaly, it's usually significant and we need to identify that. So there is an expectation that if volume has reduced, as expected on an inside bar, then spread will also be reduced because activity is reduced. Any anomaly should be noted and considered. That's important. There is often a significance that should be noted when price breaks clearly above or below the initial or controlling bar's range. Generally, the higher the volume on the initial or controlling bar, the stronger its influence on the market and the greater its significance of a breakout or breakdown in the future. Sometimes price will trade for multiple bars inside the controlling bar's range, and they're all effectively inside bars, especially when there is high or very high volume on the initial bar. This very high volume is often what may cause it to become a controlling bar. This is most often seen on a climactic bar like a buying or selling climax or something similar to that. The textbook expectation is for volumes to continue declining as more bars trade inside this stronger range. In the real world, however, this rarely happens perfectly, so always be a little flexible with this expectation. The volume should, however, generally be reducing and certainly remain lower than the initial or controlling bar's volume. If an inside bar, especially a secondary or larger inside bar, one which is traded inside the 2-bar range or greater, has considerably increased volume, the bar-by-bar trading should be analysed as normal, just under the broader proviso that the initial or controlling bar will continue to have an influence over the subsequent trading. This controlling bar effectively now forms the immediate background influence on the market's subsequent trading. Finally, when the initial or controlling bar has a wider than average spread and the subsequent inside bar has a very narrow spread or range, and especially when the inside bar trades roughly equally above and below the previous close, it may prove to be what is known in old-fashioned Wyckoff lexicon or terms as a hinge, from which a larger degree price swing may occur, sort of in a similar fashion to an equal but opposite reaction to a very strong contraction in spread. Note that under these circumstances, the contraction in spread is usually an engineered contraction in spread. It's been made to be like that. A hinge is not particularly common to find in the markets, but can be significant when discovered in a market where active professional traders are dominant. The hinge infers that prices come to a centre. It's an equilibrium. It alone does not reveal direction, but can alert the chart reader to a larger impending price move. Okay, let's look at some charts. Okay, look at this bar here first. We've had a market trending lower. The spread has narrowed considerably, but volume has increased considerably. In fact, it's the highest volume up till this point on the chart. It is actually fractionally higher than this bar and higher than this bar. So it's the highest volume up till that point. But spread narrowed. Look at the spread on this bar and on this bar and on this bar, and for whatever it matters, even though it's an up bar from that bar. It's narrower, but volume is higher than all of those bars. This was buying coming in. It was letting the market come to the buyer. It wasn't buying up. That came on the next bar when the market bought the offer, so to speak. It bought up. Volume was still high, but it was lower because the market had done its selling here, and although the offer had been reloaded to some degree, there wasn't as high a volume in the market as price went higher as there was previously when price moved lower. And then we have an inside bar, and that's exactly what you would normally see whenever you see a widespread up bar or down bar for that example. So look over here, widespread down bar, little up bar, and it's an inside bar. And you see it all the time. Here's an inside bar inside this bar's range. They're very common, and you just need to learn to identify them and understand what may be happening. And even if you can't understand what's happening, if you can work out what may happen if price moved in either direction, then when you see price move in one direction, you understand what's happening and be able to understand the subsequent price movements. So we had an inside bar here. It was effectively a test for supply, which is exactly what you'd expect after price accelerates higher like that. Whenever price moves higher with a wide spread, you'll generally get some sort of response from the market. So you would expect selling pressure to come in. So you would expect some profit taking, and that's from people who bought down below. And you'll see some people getting out from trading to the left who were in a losing position, and now prices come back to them and they can get out for break even. And that causes supply to be drawn out. You'll also get people who short the market, and that's supply coming in from above, effectively. So price, after it's accelerated higher like this, it moves into consolidation mode in an attempt to absorb the selling pressure that's drawn out in response to the sharp rise in price. So a test for supply like that is exactly what you'd expect. And you've had a secondary test, prices attempted to move higher just here, probably drawn out further supply, and then has pushed lower in response. And it's closed lower, effectively threatening the sellers. Note that the market didn't trade below the test for supply bar's low. And at that point, you would not have known whether price is going to continue lower or not. But seeing you've had a strong up bar and a test for supply, the odds are the market would like to go higher. But if supply continued to be drawn out, there may be a deeper pullback prior to any push higher. So you just have to wait and judge that as the market trades. As it turned out, price reversed and moved higher. It did draw out some supply again here, the top of that, with the almost mid-bar close. And the next bar did the same thing. Although do note that here's the high of the initial up bar through there. And do note that this bar is a breakout bar. It's broken out above that bar's high. It did draw out supply again here for a mid-bar close. So there is supply still present, but the market continues to accelerate higher. And then you'll see here, there's another little test for supply. It's not a proper inside bar. There's a little bit sticking out the top. Maybe a bit of over-enthusiasm there. And the market continued higher. And you can see that supply has been drawn out here. And price has then moved lower. It tried to hold on, moved lower again. This was Christmas here, so the volume was very low if you're looking at it. That was the 3-day trading week for Christmas. We move across a little bit and you've got the interesting bar here. There's its range. There's a very weak bar that's traded inside. Now this one's traded as an up bar, but with a very narrow spread on pretty much the same amount of volume as this widespread down bar. So there was selling pressure being drawn out here for sure. The market was attempting on the next bar to test for supply and even popped up a little bit. But with supply being present in the market, it was really difficult for price to continue higher and break out of this bar's range. And prices pushed lower in response. And it continues to hold on. It doesn't really want to go lower. You can see prices traded below the range here, but recovered again to close back within it. And then the next bar, still on pretty good volume, has also traded below it and is just trying to cling on to the lows of the range. It doesn't want to break down. If it did, the opportunity has certainly been there. This market here could have broken down here and continued lower here, there's no doubt. This is a market that doesn't want to go lower. But we're just looking at the inside bar, and in both cases, here was an inside bar on a market that had just accelerated higher, and after a couple of days consolidation, price did move higher in response. And here was a narrow spread up bar. It's an inside bar that inferred that supply was being drawn out, and price, although it hasn't broken down, is certainly threatening to do so, although it does appear that the overall market doesn't want to go lower. But in this case, we're just looking at the inside bar here. This is another chart. This is a daily chart. You can see that price has broken out of this sort of accumulation zone here. It's certainly an absorption zone, and it's accelerated higher with real vigor. And here you can see that some supply has been drawn out. There was an attempt to test for supply here. Price closed up. It probably went up initially the next day, but supply has been drawn out and price moved lower. And you can see down here that supply wasn't particularly strong. It was more likely profit taking from the lows, but the response to it was pretty poor. Look how low that volume is. Look how low demand is. Traders have pretty much gotten out, either as prices moved higher or on this bar here. And the demand for higher prices was really weak in response. And because of that, the market moved lower the next day and broke down below this bar's low. This was a weak bar. Now, in response, there's an inside bar, and it was on reduced volume, as you'd expect, because price traded in that range the previous day, and it closed poorly. So this market is weak, but it didn't go below the previous close. So next bar traded almost similarly, although on even lower volume, which is what you'd expect. Volumes continue to decline as they trade inside the range of the initial or controlling bar. And you've had price attempt to test or even a little mini shakeout here and close a little higher on a slight increase in volume, but still below the average. But the next bar saw supply come in again, another test for supply, another weak up bar, another attempt to test for supply, and a weak closing response. You've had a response where price has gone higher here, tried to respond positively, but it's closed down near its lows, and it's not a strong response. The next bar was up, but didn't really trade outside of the range of the previous bar. And all these bars are trading within the range of this initial down bar, which has become the controlling bar to some extent here. You can see it's controlling the market. Price then attempted with a bit of vigour to move higher, but closed really poorly on probably pretty good volume there, certainly higher than almost all these other bars, apart from a couple. And in response, the market moves lower. Now, this market did try to hold on here. In fact, it tried pretty hard to hold on. But once it broke below this bar's low and below the lows of this range, this is effectively a breakdown bar. And price did continue lower. You can see the response moved lower again. Price is continuing to trade sideways within this bar's range now, but it's not looking strong, and there's going to be resistance formed to the left here. Any trading that comes back to this level, there'll be people trapped into positions up here now, and if price comes back to this level, this allows some people who haven't sold to get out for break even again, and that'll cause resistance, that selling pressure that remains there. You can see on this bar here that price attempted to push back into this range again and immediately drew out increased supply. The price moved lower in response. And this market did continue over subsequent trading back to just below the 3.5 or $3.50, which it normally is when price trades sideways in an extended range like this. When price does either break out or break down, it's generally more significant than if you just get one bar trading inside. I do note, though, that you've had the two breakdown bars here. That's these two volumes. The first inside bar had much reduced volume. It's not low or lower than average volume, but it is low volume. But you can see here that when there was a down bar and it did trade inside the 2-bar range, this is the 2-bar range here, and also as an inside bar inside the previous bar's range, volume was increased. So that's telling you that supply continues to remain present in this market. The supply hasn't gone. There's still selling pressure in here. And that, although it wasn't reflected in that bar itself, is a warning sign to you. If volumes aren't generally declining, then there's still supply present. And if there's supply present in a market will rarely go higher sustainably. It may attempt to go higher, like it did here, but it's usually unsustainable. If there's supply being drawn out in a market, normally a market will pull back until the supply dries up. And once the supply is low, that allows the market to move higher with relative ease. So if you see supply being drawn out, You may get an up bar or two. They'll generally be weak and they'll generally draw out supply at some point in time. Very rarely does a market continue to sustainably push higher when supply is being drawn out. Okay, hopefully that answers the question that I was originally asked, which was why I say price has traded in the relative safety that is often found inside the range of the previous bar as an inside bar. And it's generally because price has traded within the previous bar's range very recently, so any further trading inside that bar's range finds lower volumes, and temporarily there's less activity within this range. Okay, thanks for your time. Hopefully that was worth watching. See ya.